I'm going to assume a 12-minute video and write precisely for that pacing. Most people think stability is free. Prices don't jump. Banks don't fail. The currency feels solid, calm, quiet, safe. But stability has a bill, and someone is always paying it. Not loudly, not all at once, but slowly and permanently. Here's the uncomfortable truth. When an economy looks stable, it's usually because instability has been pushed somewhere else. Hidden, delayed, or outsourced. And right now, that hidden cost is getting bigger. Let me show you how. Because this story doesn't start with money. It starts with fear. Every modern financial system is built around one nightmare scenario. Chaos, prices spiraling, banks collapsing, people losing trust in money itself. History taught policymakers a brutal lesson. Once confidence breaks, you don't fix it with speeches. You fix it with force. So after every crisis, wars, depressions, crashes, governments made the same promise. This will never happen again. That promise became monetary stability, stable prices, stable banks, stable markets, at almost any cost. And for decades it worked. Inflation stayed low. Recessions were shorter. Financial crises became manageable. Or at least that's how it looked. But stability isn't something you achieve once. It's something you maintain every single day. And maintaining it requires constant intervention. Quiet interventions. Invisible ones. Let's simplify how this system actually works. Imagine the economy as a moving walkway at an airport. If it moves too fast, people fall. If it stops, people panic. If it jerks suddenly, chaos. So someone controls the speed. That someone is the central bank. Their job sounds simple. Keep things steady. But here's the problem. The economy doesn't want to move at a steady speed. It accelerates during booms. It stalls during fear. It lurches during shocks. So to keep the walkway smooth, the controller keeps adjusting. Lower interest rates. Higher interest rates. Emergency lending. Asset purchases. Always reacting. Always smoothing. And every adjustment has a cost. When interest rates go down, borrowing becomes cheap. That feels good. Businesses expand. Governments spend. Markets rise. But cheap borrowing doesn't disappear when it's no longer needed. It accumulates. Debt piles up quietly because the pain has been postponed. This is the first hidden cost. Stability trades short-term calm for long-term fragility. The longer you smooth the system, the more pressure builds underneath it. Like tectonic plates, nothing happens until everything happens. Now let's talk about money creation, because this is where the math gets uncomfortable. When central banks want stability, they don't just print money, like cartoons suggest. They create incentives. They make it easier for banks to lend. They make safe assets unattractive. They push investors toward risk. Not by force, by design. If keeping cash earns nothing, you won't hold cash. You'll chase returns. Stocks, real estate, speculation. And that's not a side effect. That's the mechanism. Rising asset prices make people feel wealthier. Feeling wealthier makes people spend. Spending keeps the economy stable. On paper, it works beautifully. In reality, it creates a split economy. One part inflates. The other treads water. Assets rise faster than wages. Homes rise faster than incomes. Markets celebrate while rent quietly eats paychecks. This is the second hidden cost. Stability protects the system, not everyone inside it. And the longer stability is preserved this way, the harder it becomes to stop. Because now the system depends on it. Try raising rates too fast. Markets wobble. Debt servicing explodes. Governments panic. Try removing support. Asset prices fall. Pensions suffer. Confidence cracks. So policymakers hesitate. They don't ask, is this healthy? They ask, can we afford the shock? Stability becomes a trap. Every rescue makes the next rescue bigger. This is where irony enters the story. The very tools designed to prevent crises start guaranteeing them. Just later and larger. Because risk doesn't disappear. It relocates. From banks to markets. from markets to governments, from governments to the currency itself. And when risk reaches the currency layer, things get serious. Now let's zoom out. Globally, not every country controls its own stability. Some borrow in currencies they don't issue. Some rely on foreign capital to stay calm. Some import stability and export volatility. When global conditions tighten, the cost shows up fast. Capital flees, currencies drop, inflation spikes overnight. Stability in one place often means instability somewhere else. This isn't accidental. It's structural. The global system rewards the issuers of trusted money and punishes everyone else. And the price of joining the stable club is permanent discipline. Higher interest rates, lower growth, political pressure. Stability demands obedience. Now back to you, because this story isn't abstract. It shows up in your life quietly, in savings that don't grow, in housing that never gets cheaper, in markets that feel detached from reality. You're told stability is good, and it is, compared to chaos. But the question we're never asked is, stable for whom? Stable for what? Stable for how long? Because stability isn't neutral. It redistributes pain over time. It chooses who absorbs shocks and who avoids them. And the longer stability is artificially maintained, the harder it becomes to unwind without breaking something important. Here's the final twist. There is no stable equilibrium. Only trade-offs. Only delays. Only choices disguised as inevitabilities. The hidden cost of monetary stability isn't collapse. It's accumulation, debt, distortions, dependence. And one day someone has to pay the bill. The unsettling part? We don't know who yet, or when, or whether the system can survive the moment stability finally gives way to reality. And that leaves one question worth sitting with. Is stability something we're preserving, or something we're borrowing from the future?